the Bitcoin variety, I don't think it will live. I think we have two significant government agencies which will make sure it's going to die. One agency is the IRS, the other agency is the NSA.
Charles, thank you very much for joining us today.
Super to be here.
Now, Charles, you are, if I get this correct, you are Chief Investment Officer of the pension investments at Textron, is that correct?
Correct.
At the beginning of this year, a lot of people spoke about the Fed put as something that was going to support markets, equity markets, obviously I'm talking about now. But there's other commentary I've been reading recently that the Fed and central banks have had their time, and the impact they're going to have is not quite as material. And actually, this idea of fiscal stimulus is much more relevant because, you know, when we have a crisis, it won't be central banks that come to the rescue. It'll be another billion-dollar, trillion-dollar fiscal plan, which is going to help support markets. Do you think we have just pumped markets with too much fiscal stimulus over the last 10 years because it's kind of been unprecedented what's happened? And what do you think the knock-on effects are?
Well, I was raised as a UC Berkeley economist and back in the late 70s, and you know, there's only two. There's only two kinds of taxes. One the tax that you actually have to make a check to the IRS, which tends to be a very progressive tax through different structures, and then the other tax is called inflation, which is a very regressive tax. And so, all too often, because we can't politically, or perhaps the elitists don't want to invite a progressive tax, they kind of leave it, they do the fiscal expansion to where it's paid for through the other tax called inflation, which is very regressive. And we're simply just paying for some of the monetary expansion of the last 4 years because we didn't pay for it at the time through taxes. So now we're going to pay for it through the other kind of tax.
Yeah, that's actually the best I've heard it explained in a while, because a lot of people say to me, how are we going to be able to afford all this fiscal stimulus? The fact is we're paying for it already in higher prices.
Well, if you think about the definition of capitalism is making more and more goods at better and better efficiency and productivity. So therefore, capitalism is falling prices. If I'm making more of it with better productivity, it's just a lifetime of falling prices. And in fact, that's the history of the last 400 years of early capitalism and more recently capitalism as we know it. So falling prices interrupted by periods of war. So the only way to truly destroy supply and demand is war. Go out there and bury 100,000 people and 100,000 tanks, and you've destroyed the supply side. You've destroyed a lot of the demand side. You will get inflation. So, in other words, capitalism is falling prices interrupted by periods of war. And what are we getting right now? We're getting the COVID war. We're getting the Cold War. We're getting potentially a hot war in Ukraine. So this cycle is no different than what we've experienced in the last 200 years.
Let's start with the central banks then. There's a lot of talk about now whether inflation is going to be with us for a sustained period of time or whether it's just going to be just for the next 12 to 18 months and then sort of revert back to a more normal level. What about the central bank's ability to actually affect inflation? Because there are a lot of people who think that, you know, this is really just supply driven, and what central banks do is really affect the demand side of things. So what's your view on central banks' ability to actually just bring inflation down?
Well, they can bring it down through demand destruction. That's the only tool they have, right? So they can do, good point, they can do absolutely nothing about the supply side. In fact, perhaps make the supply side only worse. The supply side, given time, will respond, but if they move too quickly on the demand destruction. And interesting in this cycle, well, actually in most cycles, the market's doing that destruction for them, right? We've taken down $3.5 trillion worth of value in the stock market. We've taken down another $1 trillion in the crypto market. Remember, this is $4.5 trillion, which was, you know, represented demand for cars and planes and boats and gasoline. So the market's kind of doing the lifting for the Fed, and I think that's very much by design.
If you were to think back over the years, there are some commentators who think this feels a little bit like the year 2000, a little bit like a bubble has burst. Is that your view?
No, I think 2000 was, again, those were inflated runaway around the internet bubble. I don't see those kind of excess, but let's be honest, as Warren Buffett said, we'll see who's now wearing shorts when the tide goes out. So
right.
the tide is still in process of, of going out. We've seen Archegos, which was kind of a surprise. We've seen Tiger hedge fund that you're intimately aware with, as you know, have now officially gone to gating. So it's the first of the significant hedge funds. So I think we'll see some more of this damage, but it doesn't feel like the balance sheet of the corporate and the personal is in such fine shape. This doesn't feel like a 2000 to me.
Talked before about how having a diversified portfolio, being in certainly alternative investments, which I'm sure has done you very well. But there are a lot of people who are still in this 60-40 portfolio kind of formula. I mean, obviously the performance this year has not been great at all. Do you feel that the 60-40 portfolio is kind of, as a model, is dead for a while, or do you think it can make a resurgence back?
Look, you're a seasoned hedge fund manager yourself. The only difference between a credit bond and a stock is just simply where in the cap structure you're participating. Equity, you're junior in cap structure, and the bond of that company are just slightly senior. So of course they're going to, the spread of that bond and the price of that equity are going to rise and fall together. They're cousins. And so I don't know that the 60-40 portfolio ever necessarily bought you that much diversification. I think that was all a bit of a, I don't want to say it was a myth. It was a magical period of time in the last 40 years of just simply falling rates. And as you know, better than anyone, Jamie, that's all been falling apart a little bit. That diversification between bond prices and stock prices is being challenged more now than we have seen, again, in 40 years. Both those prices going down together, that is.
So Charles, let's talk a little bit about your process. At Textron, are you allowed to say what size of assets you have under management, and are they?
Sure. Yeah, we have about 16 billion total. About 10 of that's in defined benefit, the rest in defined contribution, US, UK, and Canada. We remain growth focused, that is, total return focused. We are not matching asset liability, or in the industry it's called LDI investing. We're investing for total returns. 116% funded, and glad to continue to grow that. To your point, this has been a more challenging year than most, but down 13% on the S&P is not, it's not a panic.
Sure. You just mentioned there actually that you have the luxury of not being asset liability matched, so that gives you a lot more flexibility on, in terms of duration. So can you explain a little bit more what that flexibility allows you to invest in, for example?
Well, I think, Jamie, there's only kind of 4 basic food groups to investing. Isn't that challenging, right? There's the bottom of the cap structure equity. There's slightly senior to that called the spread product, and then there's government rates, U.S. Treasury rates, and then arguably you could say, maybe currency is an asset class itself. Some people would push back at me and say, currency is not an asset class. It doesn't have any cash flow. So we're really only down to 3 things. And then, of course, we have 1,000 different kinds of bonds, and we have 3 or 4 different kinds of equity. And we have developed rate markets in 12 to 24 markets. But, all of the rest of this is just kind of, there's just varieties of bonds or varieties of equity. But
what about investing in hedge funds, private equity, venture capitalists? Yeah. Like, how do you have them?
We have all of those, but those are vehicles, right? Those aren't asset classes. Those are vehicles.
But I'm just thinking in terms of, because I imagine one of the things you're trying to do, and I'm not trying to say I know what you do, but is create, not have correlation of one. I mean, you did say that bonds and equities are cousins, but you must look for diversification in other ways. Sure. And I'm wondering how you find that. So
you tell me, when things go pear-shaped, you've lived through a couple of these.
But hedge funds never lose money, Charles.
Not except for this year, right? Well, because they're decidedly negative.
Sorry, let me correct that. Hedge funds aren't supposed to ever lose money.
Well, and again, a hedge fund is not an asset class. It's a vehicle. We invest in hedge funds. They do not have an asset allocation to hedge funds. It doesn't make sense. It's no more than have an asset allocation to mutual funds or ETFs. Each of those are vehicles with their unique characteristics. So yes, I have some hedge fund vehicles in the portfolio. It's not my preferred vehicle. I think there's a poor alignment of interest between the plan sponsor and the manager of hedge funds. I prefer a drawdown structure, a private equity type of structure. So I'm invested in all those different structures. I'm invested in all those asset classes. I think what you're trying to get back, what you're trying to get is what is interesting today, or how can I, if everything goes pear-shaped in a real bad drawdown, how do I stay the furthest away from that pear-shape? I think a great spot right now is real estate. So I'd love real estate, a capital raise of 300 to 400 million, which is tiny. It's a tiny amount of real estate, which is extremely niche focused. So for example, we are investing right now in a lot of cold storage and data centers and life science buildings. These are things where...
Can you be geographical? I mean, there certain parts of America you prefer?
And so when they're that small, they tend to be pretty geographic, focused. So life science, for example, these are buildings that are built specifically just for life science research. There's only about 3 or 4 places in the country, San Mateo, Cambridge, San Diego, where these buildings and workers like to cluster together. So these are very niche. Cold storage. Have you ever been to a cold storage? These are 7-story buildings which have no windows, have limited doors because they stage the food in 3 different levels. The truck comes in, obviously, and it gets taken off into a room which is 0 degrees, and then it's taken into the next room which is minus 20 degrees, and in that minus 20 degrees, there's no workers in there. There's only robots, and these are robots which are lifting food up and down on pallets, 7 stories. So it's amazing how all of us think nothing but to get on Amazon tomorrow and say, gee, I'd really like some frozen peas and corn for dinner. And in 20 minutes, it's delivered to you. I have any idea of the logistics that goes into it. And so these are things which are demand inelastic.
Right.
In a drawdown, people are still going to want their frozen pea and corn.
Kind of recession-proof areas.
Sure. You're still going to get on your cell phone, even a drawdown, and say, where's that photograph I took from 7 years ago? And you play around with it a little bit, and pops up, you go, yeah, there, of course, there it is. Yeah, any idea what goes into building and maintaining a data center so that you can pull down a photograph from 7 years ago? So in an environment like this, what you want is demand inelastic. So that's going to be data centers, cold storage. You know what else it is? It's going to call what I call our catch portfolio. We have an allocation, a dedicated allocation to chocolate, alcohol, and tobacco. 3 jugs, I consume all 3. I will pay any price they want for all 3. These are recession-proof consumer staples, right?
Did they do very well during COVID? I imagine they probably did.
They've done, people drink in good times, people drink in bad times. So yes, it's, alcohol, tobacco's done fabulous. And so what I'm trying to draw out is this concept of right now to look for things which have that kind of demand inelasticity. Therefore, you can pass through, you have good pricing power on your product.
Let's talk about credit markets for a bit. When you look at your credit portfolio, where do you see the greatest opportunity?
First lien loans, leveraged first lien loans. So there's, as you know, there's investment grade above BBB and above, non-investment grade below. I do not find anything attractive in investment grade land because you're
BBB and above?
I don't like BBB and above in anything. We are solely focused on single A, single B, BBB, as particularly in first lien loan space. And those products are, as you know, CLO risk retention, CLO equity, which is basically a 10-time levered, first lien loan, and in BDCs, which is a 2x levered with daily liquidity, first lien loan. So I have a lot of that. I love spread space. I don't call those, nor do I model those as fixed income. They are equity. So I call my first lien loan, I model it as a Russell 2000.
That's
my BDCs, I model it as a 1.5 Russell 2000. So I'm not, just because it's called a bond, it's not a bond.
I must admit, I am very much enjoying your honesty about this because there are so many people who are so formulaic and stick to the rules about which asset classes are which, but you seem very keen to boil things down into a much simpler version, which
well, on a 6-month horizon is a REIT real estate? I don't care what things are called, I care what they act like, what they behave like, right? A REIT acts like a 0.8 S&P. What does converts look like? Converts are 0.7 S&Ps, right? A lot of my peer group will calculate this thing called hedge ratio, or insurance companies calculate hedge ratios, and so they will throw their converts into their hedge ratio. And go, well, that's ridiculous. A convert's not a bond. It's a 0.7 S&P. It's not. So people need to be a little bit, to your point, a little bit more honest about what it is, not what it's called.
But it sounds like you have more flexibility. I mean, you do have that advantage of having the flexibility of being able to put things in different buckets, considering your position at Textron. How do you feel about the world of digital assets? Is it a world which you're embracing? Do you think it has a potential for a large allocation? What are your thoughts today?
Well, your preamble question was about how I feel about cryptocurrencies. So when you put this different digital assets.
Well, I mean, either
you know the space well. So as you know, there's 3 kinds of coins, and so central bank coin. There's definitely a place for that, in my opinion, because that's an easy way for the government to distribute. Don't we wish we had that in 2020 when we were distributing PPP funds?
Yeah, or the fiscal stimulus checks.
10% of the country is not banked. So a digital central bank coin, there's some concerns, but definitely. Then we have stable coins. If it's a stable coin that's one-to-one backed, I guess there's a place for it. I don't see what the point is. It should be regulated, as you know, as a money market. These algorithmic-driven coins definitely should go away. They have gone away, Luna and Terra being 2 of the largest. And then the third coin, which is the crypto, the Bitcoin variety, I don't think it will live. I think we have 2 significant government agencies which will make sure it's going to die. One agency is the IRS, the other agency is the NSA. It is.
But I think the Bitcoin bulls may say back to you, well, how can they make it go away?
Oh, they'll just strangle it to death. Well, in the next 2 years, we're going to find a Martha Stewart of tax evasion because they didn't report their Bitcoin transaction. You know, so
that's a good point. Yeah.
my assistant, she bought some Bitcoin, and she pushes back at me. She says, "Well, why, Charles? Why can't I just go spend my Bitcoin on a car? Why would I have to report to the IRS? I'm just buying a car with my Bitcoin." I said, because the IRS looks at it as a commodity, and if you pay for your car with gold, you're welcome to do that. The IRS would say, okay, what were the basis that you bought that gold, and what was the value of when you exchanged that gold for a car? And you've got to pay tax. That's the definition currently. So the IRS is going to strangle this baby, and they're going to find a Martha Stewart of tax evasion, somebody with high profile, name recognition, throw the book, because there is a lot of tax. Now then the other agency, of course, is the NSA. This is just. It is dangerous to have this type of ransom currency out there floating around. So now I would feel differently if I was in Venezuela right now, if I was in Iraq right now, if I was in Ukraine right now, right? I would want to have a place to go store and hide my wealth. But here in the U.S., it's not going to last.
How do you feel about the very quickly growing market of NFTs? Do you feel that that's an area? Fantastic.
Mainly because NFTs, where I think it's really going to have wonderful value, is to the visual arts community, right? Okay. Because the auditory arts, the music industry, have always been able to be paid royalties. So they produce something, and they can get an ongoing stream of royalties. But in the visual arts, there's never been that opportunity. Right. So I think it's very exciting for the visual art community, for people who buy, sell, trade NFTs, and for an ongoing royalty stream to go back to the artist.
Just taking NFTs on a step further, do you think that tokenization is an inevitable and very efficient way of the financial system to run?
Yes, yeah. Think how many times all of us have gone onto Google looking for an image of something to plug to and it says, Getty Images splashed across the front of it. Well, Getty Images is just simply an NFT by a different method, right? They got a whole army of lawyers who are basically enforcing you can't use that image at your company conference without paying me a royalty. So this is going to make it much easier and democratize that process to take that visual image and be paid for it.
So lastly, Charles, if I may, just one more topic and kind of tie 2 things together, which is, do you think that we're in a period of sustained deglobalization, some onshoring that's happening, and what kind of impact do you think that's going to have?
Yeah, I love the way Janet Yellen put it. She said, this is not, offshoring, onshoring, it's kind of friendshoring. That right. we now need to, I no longer need to buy my copper necessarily from the cheapest supplier, but from the one I am most politically and friendly aligned that I have confidence. Or let's put this in, Elon Musk was musing not too long ago that, gee, maybe I should go buy a lithium mine. So what's going to happen is more vertical M&A. And so what saved Tesla and what saved Apple was the fact that they started making their own chip.
They own the supply chain.
And don't you think that Ford and Stellantis are sitting around saying, darn, I wish I had thought of to make, a stupid chip that cost a nickel. Ford has had to stop production at times over the last 2 years. So we're going to see more vertical integration. We're going to see more friend-shoring. We're going to see more inventory buildups. So yes, all of this is a little bit of grist in the mill of lower prices. So if I think of the last 2 years, we've had two big events here. We've had the COVID event, and now we've had the Ukraine event. By far, the biggest with lasting impact is Ukraine, because no matter how this ends, the peace dividend is dead, right? We've had 30 years of the peace dividend. So what does that mean? For 30 years, I was able to buy my inventory from the cheapest stores. For 30 years, the government's been able to focus on butter, not guns. For the next 30, it's going to be back to guns and less butter.
Right.
So everybody's going to want to have military independence. Everybody's going to have food independence. They're going to want to have energy independence. And so could we go back to the day where, for instance, as you know, the U.S. stopped mining rare earth over 30 years ago. We have one rare earth mine down in Southern California. Rare earths are not rare. As you know, they're abundant. But to extract the rare earth material out of the soil is extremely environmentally damaging. It takes dozens of acres and a horrible process. So the U.S. correctly, 20 years ago, said, we don't want to do this. Send this to China, let them do it. Well, so now if we are less confident of that supply chain of rare earths coming from China, we're going to have to reopen that California plant. So in other words, the government's going to go back to saying, I'm going to give you a subsidy in money or give you a subsidy in regulatory comfort. Maybe we're going to get back into the business of mining for copper and mining for rare earth and mining
I think the Biden administration already is doing that with the rare earth.
And so what that means is we could end up in 10 years' time with an abundance, an oversupply of copper and rare earth, because every country is going to say, no, I want to have, as you know, right now, 80% of the world's chips come out of Taiwan. And everybody said, wow, this was a mistake. So every country in the world right now is out there to produce its own chip factory. It takes 10 years to get those up and going. In 10 years' time, we're going to have an abundance of chips. Yeah. It's just going through these inventory cycles. And so I think just as we're going to have an abundance of chips, oversupply, we'll have an oversupply of copper and rare earth and these other things as well. So this is all part of the impact of the death of the peace dividend. And again, my son, I've been able to live a career of 40 years through this globalization. He might go through his career of deglobalization, but it's 3 steps forward, 2 steps back. It's all still forward in globalization, but yes, we're taking a step back for a couple of decades.
Well, Charles, there's so many nuggets in this conversation. I can't wait to watch it back. And I just want to say thank you so much for your insights today.
Thanks for having me.